To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
So as we move ahead in discussing the redemption part, let us come back to our company's example where you said our company, they raised 1000 crores of money from these debenture holders, right? Apart from this 1000 crores, let's say they had already raised some 500 crores from various shareholders in terms of equity capital, right? Is the picture clear? There is equity capital of 500 crores. There is a debenture loan of 1000 crore, total put together 1500 crores, and the company started doing its business very well. It started earning a lot of profits. Year on year, the company was paying the interest back to the debentures. But what the company was also doing is, whatever was left out, everything was being distributed to the shareholders as dividends. Everything was being distributed to the shareholders as dividends. One fine day, when the time came for redemption of these debentures, the company said the company does not have sufficient money with it. Why doesn't the company have sufficient money? Because a lot of amount has been stuck up in bad debts. The company, whatever it earned in the initial 3-4 years, everything has been paid back, and after that the company started incurring losses, because of which the company's net worth has eroded. There is a huge amount of loss that has accumulated, and the company does not have money to repay these debenture holders. This could be a scenario which is very much possible. Though the debenture holders may have security with them, but the company is not in a position to repay the debenture holders in full, because apart from these debenture holders, there are many other people who have given, let's say, loan to the company, who are the creditors of the company, and the debenture holders, despite having security, may not be in a position to realize everything in full. Or more so ever, if they are unsecured creditors or if they are unsecured debentures, they may not be able to realize anything out of it if the company fails, right? That could be a scenario possible. To safeguard these interests, to safeguard the interest of these debenture holders, there are certain rules and regulations under the Companies Act which mandate that the company should apportion or should set aside some amount of money every year so that it is able to meet the debenture redemption obligation. Instead of rampantly paying out everything as dividends, the company is expected to set aside specific amount as debenture redemption reserve. So generally what happens, once the company earns profit, you show it as a balance in your profit and loss account, or you transfer it to general reserve. Both these are available as payment of dividend. The company may transfer it to general reserve, and from that general reserve the company may pay dividend to the shareholders. If the company keeps on paying such dividend without taking care of the redemption of these debenture holders, the debenture holders may be at risk. So to avoid this scenario, there are provisions in Companies Act which provide that you have to transfer, the company has to transfer a specific amount out of this general reserve to a separate account called debenture redemption reserve account. Now this debenture redemption reserve account, this cannot be used for payment of dividend. Now you may have a question, sir, when we pay dividend, we actually pay from cash, that is from the asset side. Why will we touch the reserves? But friends, when we pay dividend, we will debit the balance either in profit and loss account or in general reserve account. Now this debenture reserve account, though it is a part of reserves and surplus, you cannot touch this account to pay dividend, right? So that is a kind of safeguard which has been provided to these debenture holders. Even after these safeguards, there have been a lot of cases where companies have failed to repay the debenture amount on time. The companies have not been in a position to pay the interest on time. You could see the case of DHFL where they failed to pay 1000 crores of just interest. I'm not talking about 1000 crores of debenture amount that has been collected. 1000 crores of interest the company was not able to pay. Now such kind of things are possible, and to safeguard such interest to some extent possible, the Companies Act has rules where it says out of the profits, you have to transfer some amount as debenture redemption reserve. So to quickly summarize, every company which has raised money by issuing debentures, they will have to create debenture redemption reserve. Where does this debenture redemption reserve come from? It comes from transfer out of the profits which are available for distribution as dividend. So before you pay dividend to the shareholders, you have to ensure that some amount has been transferred out of that profit to a separate reserve called debenture redemption reserve. Now, what will the company do with this debenture redemption reserve? Is it that the company just needs to create the reserve and the work is done? No, it does not work that way. Whatever amount has been created as a reserve, the company has to make certain specified investments so that such investments are available when the company wants to redeem the debentures. It is not just to transfer from the general reserve and create a debenture redemption reserve. Parallel to this debenture redemption reserve, you will also need to create certain investments on the asset side. So on the liability side, you have debenture redemption reserve. On the liability side, you have debenture redemption reserve. Parallel to this, on the asset side, you need to have certain investments which can be utilized to repay the debentures. Just creation of debenture redemption reserve is not sufficient, right? How can this debenture redemption reserve be used, or how can this DRR be used? It can be used only for the repayment of debentures. You cannot use it for payment of dividend. Just because you have DRR, you cannot utilize that amount to pay the dividend. So DRR can be used only for the repayment of debentures. After the debentures has been redeemed, again whatever is the balance lying in DRR will be transferred back to general reserve. Now that we have understood the concept of DRR, let us look at the provisions which govern creation of DRR and DRR investments. Now these are given in share capital and debenture rules. You need to look at rule number 18, in which limits have been prescribed for creation of DRR and DRR investments. Now we have understood that from profits which are available for distribution as dividend, you will set aside some amount and create DRR, right? So under the reserves and surplus, you may have profit and loss account balance, you may have general reserve balance, you may have capital redemption reserve, you may have securities premium. Out of all of these, whatever is available for payment as dividend, that is your free reserves. In other words, the P&L account, the general reserve or any other free reserves which are available for payment as dividends, from that account you will transfer some specific amount to debenture redemption reserve account, and this can be used only for repayment of debentures. That is one thing what we have understood. The other thing is, you cannot use capital redemption reserve or securities premium account. These accounts cannot be used to create DRR. So one thing you have to keep in mind, always you should be using free reserves which are available as payment of dividend. Only those accounts can be used to create DRR. Let's take a hypothetical balance sheet. You have share capital of 100, you have debentures of 50, you have free reserves of 25, and you have debenture redemption reserve of, let's say, 5. This is on the equity and liability side. And on the asset side, if you see, you have fixed assets of 100, you have that inventory of 50, debtors of 29, and cash balance of 1, right? Now the balance sheet looks pretty fine. You have created a debenture redemption reserve of 5, which is shown under reserves and surplus. But if, let us say, you have to pay something to the debentures, or if you have to redeem the debentures, do you have sufficient money in the bank account? You have only one with you. Now with that one, how will you repay the debentures, or how will you even repay a part of the debentures, right? So for this purpose, it is not only necessary to create DRR, which is on the equity and liability side, it is also important to keep some money aside for repayment. Now we are not saying that you keep entire 50 aside for repayment, but keep certain percentage as prescribed by the Companies Act and the rules made thereunder. Specific amount, keep them aside, invest them in some specified securities, so that some amount of the repayment can be done using these investments. So not only DRR is important, that is a debenture redemption reserve, to keep aside some specific amount so that that amount is not paid as dividend to the shareholders. That is one important aspect. But another equally important aspect is you have to make certain investments by the name DRR investments, right? We will see what are the percentages applicable and where all we can make those investments. But the underlying concept is that blocking of certain amount under free reserves so that the company does not make payment of dividend, that is one aspect where you create the DRR. And another aspect is earmarking certain funds, keeping aside certain amount of money so that that amount is available when you have to redeem the debentures, right? So this is the concept of DRR and DRR investments. So now when we look at the rules governing debenture redemption reserve, the first rule talks about you should create DRR out of profits which are available for payment of dividend. This we have discussed in detail. Now we will move on and understand the various limits which are applicable for DRR as well as DRR investments. Now these limits have undergone changes from time to time, and if you actually look at the rules, there are a lot of categorizations which are given, but if you try to understand it that way, it might be difficult. So to summarize, there is only one category of company to which debenture redemption reserve requirement is applicable. So only one category of company is required to create debenture redemption reserve. For all other categories of companies, they are exempted. Only from DRR. DRR investment will come separately. So when we talk about categories of companies, if I classify them into two parts, one is the listed company and the other one is the unlisted company. If any company, whatever is the nature, falls under the category of listed company, then there is no requirement to create debenture redemption reserve. It may be a banking company, it may be an all India financial institution, it may be an NBFC, it may be any other listed company. Debenture redemption reserve requirement is not applicable if the company is a listed company. This is one thing that you need to keep in mind. Now if you go to the rules, you will see that first they have mentioned about all India financial institution, then banks, then other financial institution, then NBFC, a lot of complexity around the drafting of rules, but the crux is if any company falls under the category of listed companies, then debenture redemption reserves requirement is not applicable, right, for listed companies. The other category of companies and institutions which are exempted from the requirement of DRR are the all India financial institutions. Now these are the financial institutions which are declared by RBI as all India financial institutions. These are generally financial institutions of significant importance to the country. One of the example is NABARD. Financial institutions which are declared as all India financial institutions, even these are exempted from the requirement of DRR. Then banks which are governed by Reserve Bank of India, even they are exempted from the requirement of DRR. Meaning to say, if it is an all India financial institution which is again governed by RBI, or if it is a banking company governed by RBI, there is no requirement for DRR. And the simple reason behind this is RBI has its own set of measures to manage the liquidity of banks, to govern the liquidity of banks, and hence there is no separate requirement of creation of DRR. They anyways have to maintain the SLR ratio, the CRR ratio and other investment guidelines prescribed by RBI, and hence they are not required to create DRR. Then other financial institutions, other public financial institutions which are defined under the Companies Act, and non-banking finance companies as well as housing finance companies. Now I mentioned three things. Other public financial institutions, these are again LIC, UTI and other institutions which are notified by the government in consultation with RBI. Then you have non-banking finance companies. Now these are the companies which carry out lending business, but they cannot accept deposits which are repayable on demand from the public. Now what I am trying to tell here is, if you go to a normal bank, you can deposit money and you can withdraw money. You can withdraw money and the bank has to pay you the money whenever you demand for withdrawal or whenever you demand your money back. These are called deposits on demand or deposits repayable on demand. You can deposit whenever you want and you can withdraw, and the bank has to honor your withdrawal request whenever you demand for your money. So a normal bank, they can accept deposits which are repayable on demand, but a non-banking finance company, they cannot accept deposits which are repayable on demand. They can issue loans, they can give loans, they can give consumer loans, they can give gold loans, they can give vehicle loans, they can give housing loans, they can give loans, but they cannot accept deposits which are repayable on demand. So these are called non-banking finance companies. You would have heard of Bajaj Finance, you would have heard of a lot of housing finance company like LIC Housing Finance, you have Manappuram Gold Loan Company, you have Muthoot Finance. All of these companies, they are NBFCs. So for NBFCs and also housing finance companies, the companies which provide housing loans, let's say LIC Housing Finance or PNB Housing Finance, for all of these categories of companies, there is no requirement to create debenture redemption reserve. So now we have discussed two categories. Listed companies, they are exempted from the requirement of DRR. Then we have these set of banking and finance companies which are exempted for requirement of DRR. Now when we talk about listed company, they could make a public issue, that is issuing debentures to a large set of public, or they may do a private placement, issuing debentures to a small group of investors. Similarly, when we talk about those financial institutions, they might do a public issue, they might do a private placement, or they might be listed, they might be unlisted. Whatever is the category, in all of the cases, there is no requirement of debenture redemption reserve. Now you may have a doubt, what if the banking, finance companies are unlisted and then they are making a public issue? In that case, they have to get themselves listed, and again, by virtue of them being a listed company, again they will not be required to create any DRR. So however you understand it, you need to understand that the first set of companies, that is the listed companies, and the second set of companies what we talked about, the banking and the financial institutions, they are not required to create DRR. Now let's move to the third category, which is the unlisted company. If a company is an unlisted company and it does not fall into those banking and financial companies category that we discussed, then there is a requirement to create a debenture redemption reserve of 10%. So only the residuary category of unlisted company is required to create DRR at the rate of 10%. Now if any unlisted company is making a public issue, then they have to get themselves listed. So once they are listed, then there will be no requirement of DRR. Only if it is an unlisted company and it does not fall into the category of your All India financial institutions, or it doesn't fall into the category of your NBFCs, HFCs, other financial institutions, banks. If it doesn't fall into all of these categories, that residuary category of unlisted company is required to create debenture redemption reserve at the rate of 10%. Now that we have understood the limits, let us understand the timelines for creation of DRR. Let's say you are standing as on 31st of March of year 1. You need to check by 31st of March of year 2, that is in the next 1 year, in the next financial year, what is the total amount of debentures that is maturing, right? So you need to calculate that amount, and out of that amount you need to create 10% DRR. Say for example, 10 crores worth of debentures will fall due for redemption in the financial year ending on 31st of March of year 2, you need to take 10% of that and create it as DRR by 31st of March of year 1, right? So you need to see what are the debentures that are maturing in the next financial year, and out of the total value of debentures, you need to create 10% as the DRR. But as a matter of prudence, a lot of companies would create DRR as soon as possible or at the time of issue itself, right? So this is the timeline for creation of DRR. Now let us look at the limits prescribed for debenture redemption reserve investments and the timeline for creating debenture redemption reserve investments. Now you may find a disparity, like DRR was applicable to only one company, but what the rules prescribe is, as far as DRR investments are concerned or investments in specified securities are concerned, it is applicable to more than one category of companies, and the percentage prescribed is also 15%. So blocking of funds only for one category of company at the rate of 10%, whereas the investment requirement is for more than one category of company, and that is prescribed as 15%, just to ensure a better coverage for the investors. Now when we look at the limits prescribed for investment in specified securities, which we also refer to as DRR investments, for companies and institutions which fall under the category of All India financial institutions, banks which are governed by RBI, and other public financial institutions, for these three categories, there is no requirement to invest in specified securities, right? So this is the first category. Then the next category is, if it is a listed company, and it is making a public issue. If it is a listed company and it is making a public issue, in that case, there is a requirement to invest 15% in specified securities. Now, this 15% should be computed on what value? We'll come to that. But what we need to understand first is, to what categories of company is that investment norm applicable? For the first category, All India financial institutions, banking companies and public financial institutions, they are not required to invest in specified securities. If it is a listed company making a public issue, that is inviting public at large to invest in debentures, for this category, there is a requirement to invest 15% in specified securities. Similarly, if it is an NBFC or a housing finance company which is listed and which is making a public issue, even these kind of companies need to invest 15% in specified securities. So, two categories we have understood where 15% requirement is there. First category, listed companies making a public issue, right? So that is one category. The second category is NBFC and housing finance companies making public issues, and again these would be listed ones. So for both of these categories, the keyword here is listed and public issue. They are required to make 15% of investments in specified securities. But let us say these listed companies or these listed NBFCs or housing finance companies, if they are making any private placement, in that case there is no requirement to invest 15% in specified securities, right? So to have our understanding absolutely clear, what we need to see, if it is a listed company or if it is that category of NBFC and housing finance companies which are listed and they are making a public issue, in that case there is a requirement of 15% investment in specified securities. If they are making private placement, then there is no requirement of 15% investment in specified securities. And lastly, coming to the unlisted companies, if the unlisted company is an NBFC or a housing finance company making a private placement, in that case 15% investment in specified security is not required, whereas for other unlisted companies which becomes the residuary category, 15% investment in specified securities is required, right? So it may sound as if it's a very complex thing to remember, but once you revise it and once you summarize it, it will become very easy for you to understand. So what I'll do is, now I'll summarize it very quickly as to for what category of companies the DRR is required and for what categories of companies is this investment in specified securities required. So let's quickly summarize the categories of companies and the requirement of creation of DRR and debenture redemption reserve investments or investments in specified securities, right? Now, the first category, that is the All India financial institution, the banks and the public financial institutions, for these category, if at all you see it in the question as well, no DRR requirement, no debenture redemption investment requirement. So, for these categories, that is All India financial institution, banks and public financial institution, there is nothing to be created as DRR or DRI. That is the first thing. Then coming to the next set, which is a non-banking finance company and a housing finance company. Non-banking finance company and a housing finance company. Again here DRR is not needed. DRR is not needed. The investments in specified securities are needed if they are making a public issue, which means in that case they are also listed. So if they are listed and making a public issue, 15% investment requirement is applicable. But if they are making a private placement, it could be a listed one making a private placement or unlisted one making a private placement. If they are making a private placement, in that case there is no requirement for investments in specified securities. Then coming to listed companies, other than these categories of banks and financial institutions, these listed companies, again there is no requirement to create DRR. As far as the debenture redemption investments are concerned, if they are making a public issue, then 15% must be invested in specified securities. If they are making a private placement, then again there is no requirement to invest in specified securities, right? Then the last category of unlisted companies, other than whatever you have discussed above, if it is any other unlisted company, that means other than the banks, the financial institutions, the NBFCs and the housing finance companies, I will call it the residuary category, and generally this is what will be tested in the examination. If it is any other unlisted company, then there is a 10% requirement of DRR and there is a requirement to invest 15% in specified securities. Now they will not be making any public issue, they will be only doing private placements. If they do a public issue, they become listed and hence again they will not be required to create any DRR or DRI. So what you need to remember in this entire chart or entire table is, if it is any other unlisted company which does not fall into the category of the NBFCs, the HFCs, the All India financial institutions, bank and PFIs, if it doesn't fall into any of these categories, then DRR is 10%. And investment requirement is 15%. Now when we talk about investments, by when should the investments be made? What is the timeline for that? For this, we need to comply with the investment requirements by 30th of April for all the debentures maturing by 31st of March of next year. Which means if you are on 30th of April of year 1, you have to check by 31st of March of year 2, that is between these two dates, what are the debentures that are maturing, what is the total amount of debentures that are maturing or which will fall due for redemption. Out of that, 15% must be invested in specified securities. 15% must be invested in specified securities. Now, the check is not on 31st of March of year 1, but the check is as on 30th of April of year 1. So, you have to check on 30th of April of year 1. What are the debentures which will be due for redemption by 31st of March of year 2? During this period, what is the total value of redemption that will happen? Of that, 15% should be invested in specified securities. For DRR, by 31st of March of the financial year, you will check what are the debentures maturing by 31st of March of year 2 and accordingly make a 10% DRR requirement where applicable, and in this case, you will make a 15% investment in specified securities. Now, what are these specified securities? These are like, deposits with commercial bank, you may invest in certain government bonds. All of that list is prescribed. We will go through that list now. So, the investments should be made in deposits with any scheduled bank free from any charge or lien, in unencumbered securities of the central government or of any state government, unencumbered securities mentioned in clause A to D and EE of section 20 of Indian Trust Act. Again, these are specified securities which are generally issued by the government or the state government or by scheduled banks. And lastly, in any unencumbered bonds issued by any other company which is notified under clause F of section 20 of the Indian Trust Act. So, these are basically securities which are free from any charge, free from any lien and highly secured, right? For example, if you are investing in government bonds or government securities, there is a very little chance of default unless the government itself collapses, right? So, there is in fact zero risk of default unless the entire government itself collapses. So, in such securities, the investments must be made.